So I'll ask you the big question. What happened and how did fintech investing lose its shiny crown?
There have actually never been more companies getting started. Oh, it's fintech like dying and hurting. It's like, yes, later stage, there are certain kinds of models that don't work particularly well, are really challenged. But if you think intelligently about not just the product, but also the distribution and the team and the opportunity set, you can still find a lot of really, really good stuff.
Fintech last 2 years was the absolute golden child of the investing space, but that's changed a little bit.
I want to push back a little bit on the idea that fintech has been hit really hard. That's true, but at the late stage. If you look at like the pre-seed and seed, which is where all of us are most active as investors, there have actually never been more companies getting started. So if you look at the deal volume for the pre-seed and seed for companies that are, less than 24 months old, those numbers of companies creation, they're pretty much steady with 2020. A little bit lower than 2021, which was the absolute peak. And what that means is there's still a huge number of founders out there building companies. What's different and why you see the numbers in terms of the total dollars going out the door going down is those companies are raising smaller rounds and being a lot more efficient with the money that they raise. And as investors who like to back capital efficient companies, great founders, that's generally a good thing. It's just the late stage markets that have been really impacted. If you look at multiples in the public markets for public fintech companies, one of the worst trading categories is insurtechs, right? So you'd be like, oh, insurance, consumer insurance, it's a bad business. And you look at someone like Lemonade for years, and I think it's still their case, their loss ratio over 100%. So to your point, technically someone's paying a monthly renter's premium, but they actually, their claims are greater than their premium, which means they're effectively getting free money. So that's like a bad business model. I'm an investor in a company that's a B2B to C insurance, so they distribute through commerce players. Their loss ratio is way under 100%. From day one, much more reliable source of distribution, much more cost effective. So you'd say like, oh, insurance, terrible category. And you say like, whoa, actually, if you know where to look, you find the right founders, you find the right distribution strategies, you can still have really, really good companies.
Post 2008 financial crisis, we saw a lot of boom in fintech companies that were very consumer-based, right? We saw companies that were marketing themselves on an opportunity where they could occupy the big banks, and that hasn't really come to pass yet, but we have seen some really big outcomes as a result of that. Now we have an environment where there's another change shift happening, right? We're seeing higher interest rates, we're seeing an SVB failure. What's the next generation in 10 years, let's say? We come back and we talk about this.
The next generation of great fintech companies, not going to look at all like the previous generation. But as an investor, you kind of want three things, right? You want like a technology shift, you want a business model shift, and you want really great talent. So in terms of a big business model shift that's going on right now, you talked about the collapse of SVB. That is driving a huge business model shift for a bunch of banks. So SVB collapsed in, I think it was March. There are about 20 trillion in deposits in the US banking system. The number of deposits has gone up from 1980 from about 1 trillion to 20 trillion. Last year was the first year the number of deposits decreased, and before SVB collapsed, about $1 trillion left the banking system. So for the first time in literally over 40 years, because rates went up and people moved their money to find higher yield. So the business model shift from that is saying, okay, if the banks can no longer depend on the stability of their deposit franchise, that creates dislocation in the market and opportunities for fintech companies to step into that void. So there are a few examples that are a little more salient, like Mercury, for example, a business bank, neobank, they saw inflows of many billions of dollars, but that's a huge business model shift that has, like, it's the first time in, 2 generations, call it. So that's, I think, something that's pretty interesting.
And like cybersecurity becomes a bigger problem as well. And so I think we're going to see a lot more innovation around the compliance and fraud space.
What's happened, let's say, in the last 6 months? Have you continued to see that happen? Have you started to see some of the traditional generalist VC investors leaving as well for AI?
Yeah, for sure.
This happens constantly when there's the next hot thing where for a while you saw people being like, oh, I'm no longer interested in fintech, I'm just focused on Web3. And so I think people get distracted by the next shiny object, but there's always going to be capital in it. And I think it's more so just going to be, honestly, for like those top performing companies that have all the best metrics. And then honestly, the ones that don't fit into that category the raises might be smaller and the process is going to take a little bit longer, but like the capital is still going to be there.
One more big topic here is AI, right? One thing that's interesting to me is like, as we've been looking at the AI space, we've gotten these like multi-billion dollar, not quite yet outcomes, but there's multi-billion dollar companies in this space that are not from the back end multi-billion dollar companies yet. Why haven't we seen that in fintech yet?
So if you look at AWS, cloud computing, 2005, they launched their very first offering, S3. 2022 actually is the very first year that a top 5 bank announces a cloud migration of their core. So JP Morgan partnered with Thought Machine. So that's literally 18 years later to move one of your core critical systems into the cloud. So adoption of AI technology by the incumbents will just take a very, very long time. But all of our companies are using AI right now, just like they also happen to use relational databases, web technology, just like they happen to use cloud computing, right? And all that simply allows them to write more code more quickly that does more things for their customers, and they can now move faster with less money.
You're also doing a lot more private data versus the public data, and so it takes a lot longer to actually be able to build models on top of that that are meaningful in any way, because it can't just necessarily be trained on all the freely available data.
Conversely, once you do that, it's incredibly sticky. So AI-powered fintech companies, it's not like some new hotshot is going to come along and replace JP Morgan's core. It took them like probably 6-7 years to actually do that sale. It's going to take them 20 years before they do something else. So one of the nice things about being fintech investors is you can understand the ecosystem, you can understand the buyers, you can understand the relationships and the networks, and then once you do get in, it's incredibly sticky. Whereas some of these AI companies, they might come out super fast and then realize there's not necessarily a lot of defensibility. It takes billions of dollars to train the models. There are several players who can actually fund companies who can train large language models. So there's more defensibility inherent in financial services, even if it takes longer to adopt the actual end technology.
What's the opportunity that you're excited about for AI within fintech?
There have been a whole categories of companies in financial services that are highly service-oriented. And so the last wave of companies tackling this were called kind of tech-enabled. And it turns out tech-enabled didn't work very well. So you wanted to go from being like a 20% gross margin services business, add in a little bit of technology. There are several of these in accounting. And you're like, we're going to use a little bit of tech. We're going to be a 60% gross margin business. Generally, it didn't happen, didn't work. Now it's actually conceivable it could work. So AI could be a market opening opportunity where you can start out with these businesses that weren't tractable with the old tech stack, that now they can start out from day one as 60 or even 80% gross margin businesses. So that's incredibly exciting.
Canada does have a few fintechs that have popped out. They're not necessarily of the same kind of exit valuations that we've seen of like Stripe or of Revolut. But I'm curious, are any of you as seed stage investors that look for opportunities that are up and coming, are any of you guys looking at Canada? Why or why not?
The question I always talk to founders about is kind of the market size. Obviously, especially comparing it to the US, it's a lot smaller in terms of like population and whatnot. And so how can you get to that same type of scale that you necessarily need in order to build a big business? And then oftentimes you will see a business that's being built that's rather similar to one that might exist in the US or elsewhere. And so as you think about maybe like expanding beyond Canada, where exactly is the right market if that company already exists elsewhere?
Okay, unfortunately, we're actually out of time.
Sorry about that.
To you all for joining us today, and thank you everybody here for coming to day one.
Thank you, Cinda.
Thanks.